Once the excitement of getting a rental property under contract wears off, you get into the not so exciting part of verifying that you just got under contract. And if we're honest with one another, guys, due diligence isn't the most exciting or the funnest part of purchasing real estate, but it is one of the most important ones. So you want to make sure that you conduct your due diligence correctly and be as thorough as possible. That way you ensure that you're getting yourself a good deal. So in this video, I'm going to talk to you about my due diligence checklist on everything that I feel that you need to know when buying a rental property. And not to worry, guys, because this works for whether you're looking into buying a single family home or looking into getting a multifamily. So let's get started. Hey, if we're just meeting for the first time, my name is Vargas from the Vargas team, and I share with you all things real estate related. So consider subscribing to the channel if that is something that you're interested in. So in my opinion, the first item you should be looking into when purchasing real estate and conducting your due diligence is the actual market in which the property is located in. Look, in a perfect world, we would all be buying real estate in our own backyard. That way we would have a really good understanding of the market. But as I'm sure you're aware, this isn't always the case. And sometimes us investors need to venture out to other markets and other areas that we're either not too familiar with or we know very little about. I like to start by doing a quick Google Street View of the property. Ideally, what I'm looking for here is the businesses, the restaurants, and the points of interest that are in close proximity to the property that I'm going to be buying. Using this method can usually tell you a lot about the area and the market. For example, if you find a Starbucks or some other kind of franchise restaurant that is close by, that may be a good sign of a strong market. These companies like Starbucks have already done the research when it comes to determining if they want to open in a location or not. So the majority of the legwork has already been done for you. So there's really no use in trying to reinvent the wheel. Understanding the types of businesses in a market will help you understand the actual market. I have even called some local businesses in the area to introduce myself to get their perspective. This is a great way to obtain some more accurate data as to the people who work in those businesses are most likely going to be locals, and they have firsthand accounts as to the changes taking place in their own market. Talk to as many locals as you can. Not everyone is going to be helpful and forthcoming, I know that, but you will be able to speak to a few people that are very helpful and forthcoming, and that alone is going to help you keep an ear to the ground as to what's taking place in that market. Once you are done with that, then you want to obtain market reports of the area. These can sometimes be found online. Usually they're published by a local real estate brokerage office, and they're extremely useful when trying to extract additional data. Find out who the main employers are. You want to be careful that not one or two employers provide the majority of the jobs, and the reason for this is very simple. Should one of those employers choose to move shop and go somewhere else, with it goes the jobs, and that puts you in a very bad position when looking for future tenants. Make sure that the market has a very diverse and numerous employment options that will of course hedge your investment. Also, look into what industries are the most prevalent. You do not want to be in a market where one industry dominates or has 25% or more of the market share. For example, some areas and cities are very reliant on tourism, and that's okay, but in the event that tourism takes a hit, you want to make sure that the market has other industries to rely on that can pick up the slack when one isn't doing so great. So the more industries your market has, the better. Migration is another huge checklist item that you want to be sure of. Is there positive or negative migration? This one goes with supply and demand. The less that there is of something, the more it tends to be worth. And since we're dealing with rental properties, we want to make sure that there is a positive migration pattern. That way your product is always in demand, or at the very least trending in the upwards direction to getting there. This will keep your rent stable, and hopefully you'll be able to increase the rent in the years to come with positive migration. But the last thing you want to have is negative migration, with more people moving out of the city or the market, because at that point it's just a matter of time where each and every investor is going to be fighting over the same limited number of qualified tenants. And that alone, as you can guess, just tanks property values and prices, and rental prices to be exact. So avoid that and avoid negative migration like the plague. But nothing, and I mean nothing, beats physically going to the property. Can you buy a property without actually visiting and still be successful? Absolutely. I know enough people that get enough data so that they're confident in their decision in buying a property. But there's only so much the data can tell you. And then there are the intangibles. That is the information that cannot be seen or explained until you actually go there. And I'm a big proponent on how a property makes you feel when I'm actually there. If it makes you feel good when you drive the property and the area, that's a great sign, because that means another buyer is probably going to feel the same way when it comes time for you to sell it. So do your research on the front end, but make sure if you can go to the property, do it, because nothing beats physically going there. Once you have determined that the market is in par with your criteria, your next step is to focus and hone in on the property itself. So get as much information as you can about the property. You want to trust, but you definitely want to verify. And that is exactly what us as investors should be doing. So to start, obtain copies of all the current lease agreements for each and every tenant in the property. You want to comb through each one of these lease agreements to find exactly what the terms are, when their lease is set to expire, and so on. This is also going to tell you the amount each tenant is paying, and you then want to confirm that this amount coincides with your initial underwriting of the property. Make sure there are no separate agreements, either verbal or written, between the tenant and the landlord. You don't want to see a lease that says that a tenant pays a certain amount of money, only then to find out that the tenant has entered into some sort of verbal agreement with the owner to the tenant mows the lawn, and then all of a sudden for doing that, they get a reduction in rent, and that is not highlighted in the lease agreement. So clarify those points with the actual agent before moving on. Application and backgrounds for each and every tenant is also something you want to ask for. Not everybody's going to have this handy, but if you can obtain a copy of the application, the background of when that tenant actually applied for the unit, that's great because it tells you a little bit more about who your tenants are, who they work for, and so on and so forth, and you're able to know exactly the quality of the tenant that you have. You ask yourself this question: if you were the property owner at the time that the applicant has selected or sent their application, rather, would you have selected that tenant to be your tenant? So it's always good to have handy, especially for when it comes time to do a renewal. Next, you want to obtain the copy of the utility bills and confirm what utilities tenants are responsible for and what utilities you as a landlord are responsible for. This is pretty obvious, but you just don't want to have any surprises when it comes time to actually being the owner of the property. The next on the list is to confirm rent payments, and this can actually be done in a variety of ways. If you can obtain bank statements from the actual seller, that is going to be a very good tell-all if the actual tenant is paying rent and if they're in good standing. If you can't get that, then payment ledgers, usually by a property management company, will also do the trick. And if there is no property management, then obviously the next and last thing is to get a tenant estoppel. This is usually an estoppel letter signed by the owner that verifies that payments and every tenant is up to date. After which, try to get the current insurance policy from the actual seller and send that insurance policy to your own insurance provider. What you want to be doing here during the due diligence is to get an insurance quote to see if you can actually match the quote that the current seller has or better the quote. At the very least, you want to know exactly what you're getting into when it comes to insurance so that, again, your numbers just make sense. Furthermore, try to get a vendor list of each and every vendor that the seller is paying to service the property. So that includes lawn companies, pool companies, and any other third-party company that services the actual property on a monthly, weekly, or quarterly basis. You want to make sure you get those lists. And of course, any and all other expenses that you can get for the property, obviously get that. Some other additional items that I try to get and try to obtain are the rent rolls, which is just going to highlight each and every tenant and each and every unit and how much they pay and the actual unit mix of the property, along with some other additional information. Try to get the Trillion 12, which is going to break down the income and the expenses of the last 12 months of the property, basically the property's performance, if you will. The seller's disclosure, which just is the disclosure statement that the seller has signed and completed, which tells you, the buyer, the information of the property or the status and condition of the property to the seller's best knowledge. If possible, get the title policy and the survey so that you can send to your title company. The survey, for example, is going to tell you if there's any encroachments or side agreements with neighbors as to the land, if they're renting any land, if you're renting any land. So that's kind of important for the parcel of land. So try to get a survey if you can. And as I mentioned before, if you could get the property's bank statements, that's going to be really great. It's going to verify a lot of these incomes or rent payments rather, and the expenses. However, I will just mention, this is pretty hard to get, especially if it's an investor with a lot of properties. They tend not to give this out just because a lot of that is commingled with other properties. So just food for thought. But if you can obtain that, that would be amazing. There are many, many other documents that you could look into getting. So by no means am I saying to just stop here, but if you could get other documents, then by all means do so. This list that I just provided is a good, strong foundation for where you can start. And of course, it's going to aid in helping you make a decision. Moving on, we get into the comparables. And this process will, of course, help you determine the value of the property. So for number one, find out what the average rent to similar sized properties is, and of course try to stay within a mile radius of the subject property if possible. But this of course is going to tell you the type of rents that you can expect and what your competition is renting for. So super important. Find out what the average sales price is in the recently sold properties within the last 6 months. This of course is going to be able to tell you the value of the property. Now, residential properties or multifamily properties or commercial properties, if you will, are valued completely different, but it's still good to know what the properties in that area are being sold for. Find out the trends in the market to see if rental rates are going up. What were they last year? Are the homes appreciating? So you definitely want to find out where the market trends actually stand. And what are the average days on the market? Another huge thing that you want to look into, especially if you're getting into rental real estate. The average days on the market just basically means how long it takes on average to rent a property that has been listed for rent. And you obviously want to make sure that the average day on the market is is a lot less than, let's say, around 30 to 40 days is around good. But if you could get less than that, it means that you have a very strong rental market. Anything, to me, in my opinion, that's over 40 days or over 45 days doesn't necessarily mean that the market is bad. It could just be with the property. But if the average, again, is somewhere near 80, 100 days, that just means that you as an investor have a high vacancy rate, and it's going to be very difficult for you to fill any vacancies. And as you all know, vacancy kills cash flow. So definitely check on what the average days of the market is. And then one little small caveat that I've done in the past and some other investors I hear have done is post phantom listings. Now, of course, you need to check with the actual listing agent before you do this, but you can actually post the listing of the property, a phantom listing, if you will, with the pictures, just to see what the flow of the calls are and the interest. This is going to be a good way to gauge the interest of the actual market without you actually being a seller. It's kind of a trial run, if you will, before the actual test comes about, because once you're the owner, and that's it. So I like to post these phantom listings to see if I get a lot of interest, and that's going to tell me a lot about the market. I try to get all of this done before I go into the inspection, but of course you must do an inspection. I cannot stress the importance of this enough, guys. As investors, we are not professionals when it comes to inspecting homes, or at least most of us aren't anyways. But regardless, even if you are a professional, you should still always want to hire a third-party non-biased company to inspect the home. Inspectors are great because they're going to review everything in relation to the home, the condition, the cost of the repair, any red flag items, etc. So definitely get that done as soon as all the other items are done, or during. It doesn't matter, but just get it done. If the home does need some rehab, make sure you have a few quotes from a contractor. Obtain prices and bids so that you can first have an idea of what the costs are going to be when it does come time to actually do those repairs. But also you want to have that present so you can present those to the actual seller, the bids that is, to try to negotiate the credit on your behalf. And if possible, bring your property manager to the property so that they can confirm if the property rental rates can be increased or if the rents are stable enough to continue as is. Like I mentioned, due diligence is not the most exciting thing in the world, but it can be very rewarding if done correctly. And at the end of the day, guys, as investors, all we're trying to do is to make sure that we are buying a good deal. I hope that you found this information that I shared in this video valuable. And if so, do me a favor by liking this video by simply clicking that little thumbs up button, as that greatly helps out the channel and allows me to make more videos just like this one. Subscribe, of course, if you haven't done so already, and click that notification bell so you can be notified of my next week's video. And guys, thanks so much for watching, and until next time.